Business loans aren't just used for short-term cash management or buying long-term assets. Loans are a critical component of business plans. Financial leverage, which is the use of borrowed money, magnifies returns. Business and investment gurus tout how you can make big money with little money of your own. They show how using other people's money can make you rich. It's true that using other people's money, known by the acronym OPM, can increase your returns. But OPM can also be like the drug opium. Its highs come with crashing lows. Borrowing large amounts of money increases the risk your business may run out of cash or have big losses in a downturn. I'll explain how this works and how to reduce your risk. I'm going to go through a formula and a couple definitions, but don't freak out if you don't quite follow all this. I'll show some examples in later slides. Even if you don't fully understand the numbers, I want you to understand the concept that debt magnifies both returns and risk. Return on equity is how much the owners earn on their investment in the company. Return on assets is income divided by the assets of the company. It's a way of measuring how profitable the assets are. Those two returns are related. Return on equity is equal to return on assets times leverage. So that first formula leads us to ask, what's leverage and how do you measure it? Leverage refers to how much debt you have. In the ROE equation, leverage is measured as 1 plus the debt to equity ratio. Okay, so what's the debt to equity ratio? It's your debt divided by your equity. In other words, it's how much you've borrowed divided by the accounting value of your company. A ratio of 1, where debt and equity are both equal, means the company has borrowed as much as the owner's accounting value in the company. Borrowing more debt causes the debt to equity ratio to go up. Like I said, your head may be swimming a little from the formulas. Here's an important concept from the formula. Leverage by itself doesn't increase your return on equity, but it does magnify it. Here's another way of saying this. Borrowing money doesn't increase the return to the owners, but it magnifies it. So what do I mean it magnifies return on equity? If your return on assets is highly positive, borrowing money usually makes the return to the owners, the ROE, go up. However, if the return on assets is negative, borrowing money will make the return to owners to become much more negative. I'll show 2 examples to explain this more. Let's look at how leveraging a company magnifies its return on equity. In this example, the company has $1 million in assets. They have a few miscellaneous liabilities like accounts payable, but no business loans. Their debt to equity is a very low 0.11. Their profit is $100,000, so they have a return on assets, or ROA, of 10% and a return on equity, or ROE, of 11.1%. The owners then decide to get bank loans to invest in company assets to magnify the return on equity. This is the second column. They borrowed $2 million, so the total assets are now $3 million. For simplicity, let's assume they still earn 10% on their assets before interest costs. Their profit before interest expense is $300,000. Assume the loan has a 7% interest rate. They would pay $140,000 of interest expense, so their net income is $160,000. Their return on assets decreased from 10% to 5% because they now have to pay interest on the cash they got to fund the additional assets. However, their return on equity has jumped from 11.1% to 17.8%. In other words, leverage cut their ROA in half, but increased their ROE by 60%. The owners are making a lot more money. What could go wrong? Once again, leverage doesn't increase ROE, it magnifies it. Many business owners hear about how leverage and using other people's money can make them rich. That assumes a decent, unleveraged ROA. A low or negative ROA can cause massive negative ROE and cash outflows. The dark side of leverage is shown in this example. Our sample company is now earning a small loss. The first column shows their results with no leverage. They have an ROA of negative 1% and an ROE of negative 1%. Their net loss is $10,000, which is probably fairly manageable with $1 million in assets and $900,000 in equity. Now look at the leveraged column. They have 3 times as many assets, so their loss before interest is 3 times larger. A $30,000 loss may not hurt them too badly, but they also owe $140,000 in interest. Their ROA after leverage is minus 6%, and their ROE is a negative 19%. To summarize, A small negative ROA and ROE with no leverage has been magnified into a massive negative ROE through leverage. Their ROE with leverage is 17 times lower than without leverage. The biggest problem isn't earnings, it's cash flow. Companies fail from lack of cash flow, not lack of earnings. Most owners plow the full $2 million of borrowed money into non-liquid assets like real estate or equipment. Non-liquid assets are assets that cannot be easily sold or otherwise turned into cash. They may have even used some of their cash when they had only $1 million in assets as their down payment or equity portion of those illiquid assets. They may have nowhere near the cash left to service a $170,000 loss. As a banker, I saw this happen with many business owners during the Great Recession. Real estate investors and owners who made big expansions before the downturn were caught with little cash and big payments. To put this all together, you must balance both profit and risk when deciding how much to borrow and how to use the cash from that borrowing. Borrowing funds to increase your investments and grow your company can cause the return to owners to greatly increase. On the other hand, the return to owners is decimated if the investments start earning low or negative returns. More importantly than earnings is cash flow. When you have decent income from investments, it's not hard to cover your loan payments. You will need to have a good reserve of cash available for your loan payments when earnings falter, though. I encourage you to keep a larger reserve of cash as your borrowing increases. The increased borrowing increases both your profits and your risk. Over the long term, the cash reserve will allow you to keep most of the profits and reduce your risk. Using leverage and keeping reserves mean you will receive higher returns during the good times while covering your loan payments and losses during the rough times.